First, thanks for mentioning our 50 million fund. This is coming from the bank, but also from our employees, obviously led by our management team and our board. First half is for quick relief. The second half is for redevelopment, and we would hope that this can catalyze some other efforts. And this is in addition to a $1 billion preferential financing facility that we put in place. I'm delighted to say we've had the first drawdowns on that facility already. And this is money that will go out to clients of ours, or it could be new clients as well, who are helping in the fight against the pandemic. So we've got about $300 million of loans going through the approval process right now, all on preferential terms. The objective being to catalyze both us, our colleagues, but also our clients who can help fight this fight. But to your question on the impact on the banks comparison to the financial crisis, obviously it's different in many fundamental ways. So the financial crisis, we know, had at the heart of the financial crisis was the banking system, which was severely stressed, and there were questions whether the banking system was going to be able to fight the fight to get the economy back on track after the economic shock that we experienced. That's not the case this time. The banking system is very strong. In fact, it's demonstrating through the kinds of things that Standard Chartered is doing in its own ways, but I think every bank has got some variation of program, of course, supported by central banks and governments, to take this very, very substantial monetary and fiscal stimulus that we're experiencing, or fiscal support that we're experiencing, to get the economy going again. So the fact that the banking system is strong going into this bodes very well for a better recovery. Now, that said, the shock that we're experiencing in the first place is at least as severe. And I'm going to say, as this pandemic unfolds, and none of us knows exactly, or maybe even generally, how this will progress over the next 6 to 12 months, we have to expect that the economic impact is very, very material. So the need for this massive monetary and fiscal action has never been greater.
I want to ask you about cash reserves. It's been this torturous journey since the financial crisis to try to build up those capital reserves. In the UK, at least, there's now a conversation about whether this is the rainy day. This is what the banks have been saving for, and it is time to draw down on that capital. But we know as soon as we get out of this crisis, the banks will then have to try and restore those capital levels. Just talk us through it. Do you think this is the time to raid the bank and spend some money to try and shore up the economy, shore up some of those clients?
Yeah, and I think we are. So I think that there's some natural mechanisms that kick in, like corporations have revolving credit facilities that are for long periods of time undrawn. And to some extent, they've been drawing those facilities down. So that has the effect of increasing assets on bank balance sheets, which therefore consume some capital. We know that financial markets have been extremely volatile. It creates mark-to-market positions that also have the effect of increasing capital. Banks, I think, are doing the right thing in terms of oftentimes together with government, using their balance sheet to support the industries that have been affected, or companies that are fundamentally strong and viable, but going through a very difficult time because their business has been impacted. So I think we'll see a natural expansion of assets, which consumes capital. I think we'll see downgrades. Those downgrades also have the effect of, because the capital itself is calculated based on the riskiness of the assets. As companies are downgraded or the credit becomes stressed, the risk-weighted assets or the required capital will go up. So I think there will be a number of automatic steps, as it were, that will increase the capital that banks are committing, which will reduce capital ratios. Some of those things will also reverse naturally after the pandemic passes. So corporate health will be restored. Yes, please.
Yeah, sorry to jump in, Bill. A lot of question marks about the speed of recovery, and just looking at the template from the last crisis, US banks came out of it a lot quicker than their European counterparts. They realised loan losses a lot quicker and they moved on. I have concerns that when we see the likes of JP Morgan already writing down the value of the loans, the European banking system and the regulators' encouragement say get your loan losses out later on when they actually happen, rather than when you think those loans are impaired as well. Do you fear we're going to make the same mistakes this time round and end up in Europe with a whole host of zombie loans that stay with us right through?
I hope not, because I agree with implicitly in your question that would not be the right way to restore health to the system. Of course, we know that in the U.S., the other step that the government took, that the Fed took, was to recapitalize the banks at an early stage after the crisis through what was the TARP program, $750 billion, in addition to many other programs. So there was a write down and recapitalization. I think a few things have changed since then, but one important accounting change is something called IFRS 9, the effect of which is to force banks to recognize the expected loss in their credit portfolios based on macroeconomic forecasts upfront. So I think that doesn't apply to the U.S. banks, although there's a variation of those accounting rules that do, and that's the basis for some of the write-downs that the U.S. banks have taken. But I think what we'll see, and as European banks announce their earnings, and I think you saw some of that from Credit Suisse this morning, is that the accounting requirements force us quite appropriately to recognize expected losses, and that will go some way to offsetting the effect that you're talking about.